Welcome, everyone, and thank you so much for joining us. Today's session is focused on a gap that shows up in almost every HVAC business, the difference between what a business looks like from the inside and what a buyer would actually pay for it. Most HVAC businesses look strong. Revenue is there, jobs are getting done, and the phone is still ringing. But what we see every day is that most owners are making major decisions around growth, hiring, pricing, structure, without actually knowing what their business would sell for and what that is driving that number or what's holding it back. That gap is where a lot of costly decisions get made. Today is all about making that clearer, helping you understand what buyers would actually look for when they're buying HVAC businesses, what drives that value, and why two companies that may look similar on the surface can end up with two very different outcomes. Please feel free to drop any questions you may have throughout the session in the chat box. We'll save some time at the end to answer any of those questions that come up. But to walk us through that discussion, we have John Bartlett, founder of Brentwood Growth. John works directly with HVAC business owners on valuation, value acceleration, and sell-side advisory with a focus on building businesses that are not only profitable but transferable. He has led and advised on transactions involving hundreds of millions in enterprise value across service businesses. With that, John, I will go ahead and hand it over to you.
Thank you, Courtney, and thanks everyone for being here. I know you guys are busy and had to carve out a little bit of your day to participate in this, but I really appreciate you doing this. And so the real purpose of it today is we just want to present some concepts to you so that maybe you can begin thinking about sort of where you are and where the business is and what you're wanting to do with the business and how you're moving the business towards that objective. We're not here to force anyone into, doing something that they're not ready to do. I know running an HVAC business, it's demanding. There are a lot of moving pieces. You're trying to get the work-life balance right. I get all that. I get all that. But we just wanted to plant some seeds of some ideas that we think are important for you to consider. And when you're ready to have the conversation, if you feel like you'd like to have the conversation with us about some of the aspects that we're going to talk about here, then we want you to know who we are and how we work with business owners like you guys. Quickly about Brentwood. We are an advisory and consulting business. We work with service providers and contractors in the trades. That's all we do. We have about 25 sectors that we cover: HVAC, plumbing, electrical, roofing, garage door, lawn care, landscaping. The list sort of goes on. It's service providers and contractors that are residential, industrial, commercial focused. And the type of work that we do falls into one of three categories. Um, Certain owners simply want to know what the value of the business is and what the value of the business could be, and we're able to put those valuations together for them and put projections together as to what the business potentially could be worth. After that valuation is completed, if they want some help in scaling the business, growing the business, being more focused on profitability and cash flow and strategic alignment in terms of the priorities that they're working in and driving enterprise value into the business so that they can have the outcome they want to have within the time frame. We've got a consulting arm that could potentially work with you in that area. And then thirdly, if you're ready to sell the business and we think the value of the business is in line with what your expectations are, and um, you feel like we're a good fit for you, and we feel like that we're going to be able to run a process and get good demand for the business, we would love to talk to you about potentially selling the business also. So the three service areas that Brentwood can help you with is getting a valuation done, consulting with you on growing the business. And if you want to sell the business, we can have that conversation as well. We've got a buyer network that we've built. We have, it's close to 3,000 buyers now. It's a combination of private equity firms, independent sponsors, family offices, other strategic buyers. We've done probably 40 or 50 deals. The average enterprise value of those deals is roughly in the $10 million range-ish. Um, Anytime you do averages, half are bigger and half are smaller. And so, we've sold companies that have enterprise value north of 50 million, and we've sold companies that have enterprise value barely over a million. And so there's a pretty big range there. One of the things that's unique about our transaction part of our business is all of our fees are success-based. We don't charge a retainer. We don't charge any money up front. We only get paid when the transaction's completed. Um, I think as we go through the conversation today, um, some of the things that you're going to come away with, you're going to come away with a better understanding of how valuations are done and in a broad range, what the value of your business is and could be. I think you're going to get some more clarity in terms of what you need to sell the business for in order to be able to retire potentially to support your lifestyle. And then thirdly, we're going to be able to point out some high-level concepts in terms of the kind of characteristics that buyers are looking for that allow the businesses to achieve the highest valuation as possible. And so it's going to be a combination of things that I think you're gonna come away with. This webinar is designed specifically for HVAC business owners, both commercial and residential. And it's probably no surprise to you guys, the HVAC industry has been one of the industry segments that the buyer demand has been incredible for years and years and years. Whether it's private equity firms, whether it's independent sponsors, whether it's family offices, whether it's strategic buyers, whether it's owner owner operators. HVAC businesses are great businesses from a buyer perspective. There's consistent demand, there's reoccurring revenue. It's a highly fragmented industry with, tens of thousands of independently owned HVAC companies still. Um, Private equity firms are doing roll-up consolidations in the sectors, but there are other strategic buyers that are wanting to grow and they're wanting to buy adjacent businesses um, to help them grow. And so there's just really good demand for HVAC businesses right now. First question we have to ask is how do you determine the value of the business? Well, the value of the business really comes down to two numbers. It is first, what is the actual cash flow profit of the business? And then secondly, what multiple of that cash flow profit is a buyer willing to pay for a business? Now, let me unpack those a little bit. First, what is free cash flow? Um, I always say that there are three profit numbers. There's what our tax return shows, and then there's what the QuickBooks files show in terms of net operating income, and uh, it's the actual profit of the business. And so when we talk about free cash flow, and I'll explain I'll explain this a bit further, but we're wanting to look at what the actual profitability of the business is from the buyer's perspective once certain adjustments to the QuickBooks P&L statement has been done. We want to pull all the personal expenses out. We want to pull all the reoccurring or the non-reoccurring charges out. We want to pull interest out. We want to pull depreciation out. We want to be sure that there is or no, a normalized owner's compensation number. And so we want to determine what the actual free cash flow profit of the business is from a buyer's perspective. And then from that, we're going to make certain assumptions as to what multiple of that free cash flow profit a buyer's going to pay for the business. At the end of the day, any business, its value is based upon the business's ability to produce cash flow profit, and a buyer measures their risk by the multiple that they're willing to pay. Smaller businesses that have fewer clients and other characteristics that we'll talk about in a moment from a buyer's perspective, that business is more risky from a cash flow standpoint, and they're going to pay a lower multiple for that business. Larger businesses with more clients that are more service oriented, that has more recurring revenue, that's got a leadership team, that's got a management team that doesn't have a lot of owner dependency, they're going to view those businesses as being less risky, and they're going to pay a higher multiple for those businesses. And so the value of any business really comes down to two numbers. What's the actual cash flow profit? And then what multiple of that cash flow profit is a buyer willing to pay for the business? I talked about this a moment ago. We want to be sure that the owner's compensation is properly normalized. We want to be sure that all the personal expenses are pulled out of the P&L. We want to show that cash flow number as high as possible. We want to be sure that if there are any one-time expenses that the business had to pay for last year, we want to be sure that those expenses are pulled out. We want to come to what the true operating profit of the business is from a buyer's perspective, day one, when they own the business. And so that's the cash flow number that we're wanting to achieve. The multiples, you'll see an example in a moment when we talk about multiples. Again, the first thing we've got to do is determine what that cash flow profit is. The second thing we have to do is determine what multiple a buyer is going to pay for the business. Are they going to pay 3 times cash flow? Are they going to pay 4 times cash flow? Are they going to pay 6 times cash flow, 8 times cash flow, 10 times cash flow? What multiple are they going to pay for the business? There are a lot of things that go into the multiple that they're willing to pay, but really what they're doing is they're managing the risk of that cash flow changing should they buy the business. And so the management of that risk is what's going to determine the multiple that they're willing to pay. They're going to look at what the revenue mix is, how much of it's install work, how much of it's replacement work, how much of it is service and maintenance work. They're going to look at the number of service and maintenance contracts that you might have. They're going to look at what the leadership team is, what the management team is, how dependent the business is from the owner on a day-to-day basis. The owner might be the primary salesperson. The owner might be the primary dispatch person. The owner might be the primary manager of the field techs. They're going to look at what the owner's dependency is. They're going to look at what the leadership team is and the amount of independence the business has from the owner being involved. And so that whole leadership team, management team, owner dependency aspect is going to impact the multiple that a buyer is going to pay for the business. They're going to look at consistency of profits. They're going to look at consistency of cash flow. They're going to look at what your profit margins are. And so any inconsistencies that exist there, they're going to measure their risk by paying a lower multiple. They want to buy, they want to buy businesses that have processes in place, that have documented processes in place, that have systems in place from an operational standpoint, from a dispatch standpoint, from a field operation standpoint, from a collection standpoint. Um, the more we can build consistent documented processes and the more that that is codified, that gives the buyer more confidence that they're buying a business that has standard operating procedures and everyone's following the same playbook from a marketing standpoint, from a sales standpoint, from an ops standpoint, from a field management standpoint, from a collection standpoint, all this is being properly codified and there's consistency there. All that's going to matter in the way a buyer views the business and in terms of what multiple that they're willing to pay. Let's let's look at an example here, and this is very similar to the way that when we do evaluation, the way that we'll put potential uh, projections together as to what the potential value of the business is. So let's say we're taking a look at a business, and last year the actual true profit, the adjusted EBITDA profit of the business, let's say it was $600,000. And you've got the profit numbers building here from a growth standpoint over time, and then you've got the multiples expanding here. And so right now, if we took this business here to market to be sold, it would probably sell for a multiple of somewhere between 3 and 3.5 times. And so you've got a business that's generating 600,000 of cash flow. It's going to sell for a multiple of 3.5 times. So the value of the business is somewhere between 1,000,008 and 2,000,001. So here, calendar year 26, let's assume that we're able to achieve a 20% growth rate on the business. Let's assume that the cash flow grows 20% from calendar year 25 to 26. The cash flow in calendar year 25 is going to be $750,000. Well, not only is the cash flow $150,000 higher because we were able to grow the business, but the second thing that happens is the multiple begins to grow. The multiple begins to expand because there have been things that you've done within the business um, in terms of changing what the revenue mix is, potentially changing what the client concentration is, putting systems and process in place, building the leadership team, having consistent lead flow. As the business grows, the business strengthens and the infrastructure gets stronger and the standardization of the business gets better. The owner dependency goes down. And as a result of that, the multiple begins to expand also. So got a business that's kicking off 750,000 of cash flow. The multiple expands to perhaps 3.5 to 4 times. You've got a business now that's worth somewhere between 2.6 and $3 million. And so you can see here following this chart through, the cash flow continues to expand. At the end of 5 years, the cash flow's 1,000,008. The multiple continues to expand. The value of the business, when you take the cash flow, when you take the expanded multiple, you've got a business now that has a potential value of somewhere in the $10 million range. How did we get there? We did two things. We expanded the cash flow profits. We minimized the risk in the business from a buyer's perspective. The multiple was able to expand. Therefore, we have higher cash flow. We have a higher multiple. You compound those together. We've got a business that has grown in value from $2 million to almost $11 million over a 5-year period. That's how it happens by increasing the cash flow, expanding the multiple, the value of the business then grows as well. Um, there you go. So a lot of times when we look at a business, you can have a business that is heavily contractor dependent. It might be generating $10 million of revenue, but it's more of a construction contracted oriented business. And so the profit margins in that type of business is going to be lower. The cash flow is going to be lower. And because it's project-based new construction, the multiple that a buyer is going to pay for the business is going to be lower as well. So a lot of times we'll talk to contractors and they'll have a very big top line number, but when you look at what their gross margins are, the gross margins might be in the 25 to 30% range. Their net margins might be in the 10% range, and they're going to trade for a multiple of maybe 3 to 4 times. And so it's a $10 million business that is oriented differently in terms of what the revenue components are. The margins are different, the profitability is different, the multiple is different, the value of the business is going to be different. Compare that to a service-based HVAC business. It's doing 10 million of top line. Its gross margins are maybe in the 40 to 45% range. Its net margins are maybe in the 20% range. The multiple that it's going to trade for, because it's a service-based business, there's a lot of reoccurring revenue. The multiple is not going to be 3 times. The multiple might be 6 to 7 times. And so you've got a construction-oriented HVAC business that might be worth $2 to 3 million. You've got a service-based HVAC business that might be worth $8 to 10 million. And so you can't look at the revenue number and assume that the value of each of these businesses are the same. You've got to look at the various components underneath that to determine what the actual profitability of the business is and what the multiple the business is going to trade for and what the value of the business is. It's going to vary business by business. The things that are going to drive the multiple, it's going to be the revenue mix. It's going to be service agreements that you have. It's going to be efficiency in terms of how you run your tech crew. It's going to be what your operating profit margins are. It's going to be systems that you have in place. It's going to be what your lead generation um, process is. Where do jobs come from? Are they referrals? Or do you have a standardized lead generation process, and is a buyer able to scale that? It's going to be what is the owner dependency of the business? Do you have a leadership team in place? Do you have KPIs? Do you have metrics in place? Are you able to step away from the business for a week, for 2 weeks, for a month, and the business is able to run itself? Or is the business very dependent upon you? All of these factors are going to determine what the multiple that a buyer's going to be willing to pay for the business, which is going to drive the value of the business. When we do evaluation, what we're going to do is we're going to determine what the value of the business is today, and we're going to show you how we arrived at that number. We're going to make some assumptions as to if you do this, if you do this, if you do this, this is what the value of the business could be within your time frame, within 2 years, 3 years, 5 years, 10 years, whatever the time frame is. And so we've got the value of the business today. We've got what the potential value of the business could be. And then we've got that value gap there. The business is worth $3 million today. You want to build the business to a value of $5 million in 5 years. There's a value gap there of $2 million. We're going to show you from a financial standpoint what needs to be done to close that value gap. And then we're going to put a roadmap together for you on the things that you need to be focused on to ensure that you hit the financial targets that are set, to ensure that the multiple continues to expand and the risk in the business goes down, so you have the exit optionality that you're looking for on the back end. And so this is what we do to help you figure out what that value gap is. Second thing you've got to do is you've got to figure out what the wealth gap is. And by the wealth gap, what we're really talking about, and we're not wealth advisors and we're not personal financial planners, and by no means am I trying to give you investment advice. But from a conceptual standpoint, what we do want you to think about is um, when you think about what the value of the business needs to be in order for you to sell it, in order for you to retire one day, should you choose that that's the path that you want to go down, you need to be grounded in terms of what do you sell? What do you need to sell the business for in order to have enough investment assets so that those investment assets produce the income that is going to be required to support your lifestyle in retirement? And so one of the things that we can help you do at a very high level, but you really need to be talking to a wealth advisor, financial planner that can drill down the specifics around this, is what is the amount of monthly income that you need in order to support your lifestyle in retirement? What does that look like on an annualized basis? What does that then look like on a pre-tax basis? And then how much do you need to have in investment assets in order to produce that income? And so there's a totally separate analysis that um, you need to go through to determine what that wealth gap is that you need to sell the business for in order to backfill the investment assets that you need in order for you to be able to live comfortably in retirement. Where owners sometimes get stuck in all of this is they don't have a clear understanding of what drives enterprise value within the business. They A lot of times people think, well, if the revenue is this, the value of the business must be close to that number. You got to go through the valuation process to really determine what the actual value of the business is. You need to understand the way a buyer is going to view the business from a valuation standpoint. You need to see what's strong within the business from a buyer's perspective, what's weak within the business from a buyer's perspective, and you need to build a roadmap in order to close those gaps and to build that value that can help you achieve what you're wanting to do with the business. And so I think owners get stuck is they've never taken the time to sort of understand, okay, what's the value of the business today? What determines the value of the business today? What's going to drive value in the business tomorrow? How can I accomplish that with everything else going on within the business? What do I need to sell the business for? Do I even want to sell the business? And so that's just taking the time to sort of figuring out what some of those long-term options are. It's a lot of, you've got a business to run along the way, and there's just a lot of moving pieces to deal with, and you've just never taken the time to sort of think it through, to understand some of these concepts, to come up with some answers as to what it is that you're wanting to accomplish. And having conversations with groups like us can help you get greater clarity in terms of what you really wanted to do with the business. The longer you wait, the business gets stuck. The business doesn't change. The clock is ticking. Um, if there's a gap that needs to be closed, unless you're intentional about closing that gap, then you're going to end up you're going to end up the same place 5 years from now that you are today, and you just lost 5 years of being able to close those gaps. And so I would say the more information that you know, the more grounded you are in where you're taking the business, the clearer you can be in terms of what your objectives are, in terms of what you want to do with the business, short, medium, and long term, and what the timeline on that is. It helps you develop a specific plan instead of waiting. Um, the hardest part of my job is we'll do evaluation of a business for a business owner, and I've got to have the conversation with them. He thinks his business, he's doing 3 million or he's doing 5 million, and he thinks the business is worth 3 to 5 million, and he's 65 years old and he's tired, and um, he he's ready to sell the business. But when we look at the financials, when we do the valuation, Instead of the business being worth 3 to 5 million, the business is worth maybe 1 million, even if we could find a buyer for the business. And so this slide says why deals fall apart. And I think it's they fall apart because sellers have unrealistic expectations in terms of how the market's going to price the deal, or they fall apart because the number that they know they need to sell the business for and what groups like ours tell them the business is worth, there's a big gap between what they want and what the business is worth, and they fall apart there because the deal never goes to market because there's too big of a gap. And so I think you hear these statistics that 80% of deals that go to market never get sold. Well, they never get sold because they never should have gone to market in the first place. I can tell you our process, 80% of the deals that we bring to market get sold within 6 months because we're so picky on the deals that we take on. And so we want to be sure that when we take a deal on and when we take a deal to market, that there is clear that the seller's expectation in terms of how the market's going to price their deal is in line with where we think um, the market's going to price it. We think we've got 3,000 buyers in a buyer network, and we want to be confident when we take a deal to market that we can run a competitive process and we can bring multiple offers back to the seller. That's the second thing. Third thing is we want the seller to be clear in terms of what they're looking for in terms of the nuances of the sale. Are they looking for an all cash offer? Are they wanting to sell a piece of the business and stay involved in the business? And so there are all sorts of different ways a deal can be structured. And we want to be sure that when we bring a deal to market, that the seller is clear in terms of what they're willing to accept and what they're not willing to accept. And so going back to the answer to this question, I think deals fall apart because they never should have been taken to market in the first place. Um, Selling the business outright is a path, but it's not the only path. It can be a full sale where you sell the entire business to a third party. You get a check, you call it a day. It could be a partial sale where you're selling maybe 70, 80% of the business to a third party. You're continuing to stay involved in the business. Um, you and your partner now are continuing to grow and scale the business. In 3 to 5 years, it could be your objective to sell what then hopefully is a larger business. You still own 20 to 30%. You've stayed involved in the business for 3 to 5 years. You were able to pull some chips off the table through the first sale, but then the business sells a second time. You get a second bite of the apple, and oftentimes that check that you get, that second check that you get, if you found the right partner and you guys have executed a good plan, the second check that you get could be larger than the first check that you got. And so that's a second option is a partial sale. Third option is it doesn't have to be to a third party. It could be a sale to a family member or someone that's on the management team, or perhaps you might think about doing an ESOP where you sell the entire company to the employees. And so there are various options in terms of different buyer groups. And instead of it being a third party external sale, it could be an internal sale. The final option to consider is you don't sell the business. You set up a self-managing business instead of you being crushed, working 70 hours a week. You set the business up right. You get a management team in place. You get KPIs in place. You get metrics in place. 70 hours a week becomes 10 to 15 hours a week. You continue to draw a salary. You continue to draw profit distributions from the business. As the business continues to grow and scale, the profit distributions that you're able to pull from the business gets larger and larger and larger. And the thing that I'll tell you is you will never find an economic engine more powerful than the business that you're sitting on right now. And so I don't want you to think that selling the business is the only option. Setting up a self-managing business is a terrific option for those that want to explore that, and the power behind the profit distributions that can come from a business that's run properly. You're not going to find anything like it. Um, I would encourage you to think about getting a valuation done. Evaluation is going to help you make better decisions in terms of how you're running the business. It's going to help you determine what's going to reduce the risk. Even if you choose not to sell the business, the things that we're going to point out from a valuation standpoint, from a risk management standpoint, it's going to make the business a better run business anyway. And so even if you have no intention of selling the business anytime soon, I think the roadmap that we put together for you is going to make it, it's going to give you ideas on how to make this a better business and help you set strategic priorities within the business. And it will just give you a better strategic roadmap in terms of um, things that you might want to think about on how to strengthen the business. I think three questions to ask yourself. What would you do if you sold the business today, or be thinking about what you might want life to look like if you sell the business? How much capital do you need from an investment standpoint in order to be able to retire profitably? And then thirdly, what's preventing you from being able to be confident that you've got a growth plan where the value of the business can come close to achieving exactly what you need the value of the business to be. What we can help you with from a valuation standpoint, and that's where we would encourage the next step to be potentially. If you want to talk further, we can help you figure out exactly what the real number is, what your actual EBITDA profit is. We can give you a clear idea as to what multiple range buyers are going to pay for the business, and help you determine what the value of the business today is and what the value of the business potentially could be within your time frame. We can help you at a very high level figure out what you need from an investment standpoint to be able to support your lifestyle. We can help you figure out what that wealth gap is and what that value gap is, and we can certainly help you set up a strategic plan in terms of the things that you need to be focused on in order to close some of these gaps. So we'd love to have a conversation about you personally, about the business, to see if there's any way that we can help you through this journey. If you click on the QR code, you can set up a call with me, and I can bring other members of the team in. Um, we'd love to talk to you. Thank you for your time, and I'll open it up for any questions that you have.
I have a couple of questions that came in. So the first one is, I'm pretty involved in sales in some of the bigger jobs. From a buyer's perspective, how big of a problem is that really, and what do they expect to see instead?
Well, in a perfect world, you would have a sales team. I don't know the size of the business, obviously, and so I don't know what your infrastructure looks like. But in a perfect world, you would have a marketing team that has a leader. You would have a sales team that has a sales manager, and you've got sales reps. And then you can go through the other operational functions within the business. In a perfect world, you would have a sales team that has a sales manager that has sales reps. The sales reps are directly responsible for the relationships that are driving the business. you as the owner get involved occasionally from a relationship management standpoint, but the primary relationship is with the sales team. Now, you've got to be a fairly large business in order to for you as the owner not to be involved in some aspect of the the relationship of the estimating, the proposals, closing the business. And so I think as you grow and scale the business over time, that owner dependency that you're playing such a critical role potentially in right now, you want to try to figure out how you can develop a plan that cuts back the owner dependency where you're involved ultimately in very little of the new business acquisition.
Thank you. The next one that I have is our margins can be a little up and down depending on the month or the type of work. How much does that actually impact what a buyer is willing to pay?
It's not going to matter month over month. And so what from a P&L standpoint, from a cash flow standpoint, what we always do is we don't look at month over month per se. We look at the trailing 12 months. And so like today's April the 29th. And so we would close the books out for the month of April, and then we would go back 12 months and bring a full calendar year in, which allows any volatility because of seasonality within the business to be smoothed out. And then as we're showing the P&Ls and we're showing the financials, it's not April's P&L and May's P&L and June's P&L. Every month we're showing a trailing 12 months where we've got a longer time frame that is smoothing out that inherent volatility. And so that trailing 12 months is what's allowing averages to be sort of normalized. And so you don't see the volatility that that you're pointing out. That takes care of that for you.
Okay, awesome. I have two more questions so far, and again, reminder for everybody, feel free to leave any questions in the chat as well. So another one we got was we've leaned pretty heavy into installs, but margins can fluctuate. What do
Right.
buyers typically want to see from a margin standpoint?
I would say on the install work, well, the first thing they're going to do is they're going to look at from a revenue perspective, how much of it is install work, how much of it is replacement work, how much of it is service and maintenance work. And so they're going to divide it into those three buckets. And then they're going to look at each of those three buckets and they're going to put benchmarks in terms of what they want the profit margins of each of those three components to be. So I mean, for example, it might be the install work. They want the gross margins to be in the 30 to 35% range. It might be in the replacement work. They want those gross margins to be in the 35 to 40% range. It might be in the service and maintenance work. They want those gross margins to be in the 40 to 50% range. And so each of the three components are going to have different benchmark requirements that they're going to want each of those divisions to achieve. And then when you blend everything together based upon how much of it is install work, how much of it's replacement work, how much of it is service and maintenance work, then there's a blended gross margin that they're wanting the business to achieve. Now, in a perfect world, they would want everything to be service and maintenance. They would want everything to be under a service and maintenance agreement, and would want everything to be close to a 50% gross margin level. But I mean, no business is going to be like that. And so you've got to look at what the revenue mix is. You got to look at how much of it's install work and how much of it's replacement work and how much of it's service and maintenance work and then what the gross margins are. And so every business is going to be a little bit different because the revenue mix and the margins are going to be different.
Awesome. Thank you. The last question I have so far, is if I'm not looking to sell right away, how should I be thinking about this? What should I actually focus on over the next couple of years to make sure that I'm not leaving value on the table?
That's a that's that's a great question. I think you should you should get a valuation done as to what the business is worth, and we can do this for you. You should put um, sort of a stake in the ground. I want the business to grow in value to a number, and either you can give us a number and we can reverse engineer, or we can take the business today and we can say, okay, it's going to grow at 10% a year or 20% a year, whatever the number is. And then once you get a realistic, say, 5-year projection plan together, then you need to be thinking about what is everything that I need to do over the 5-year period, broken down over 5 years, and then broken down over the next year, then broken down over the next 90 days. What is everything I need to do in order to achieve the work-life balance that I want to achieve over the next 5 years, to reduce the stress in my life, depending upon what the stress level is that you have and what stress level you're willing to um, take on, and to to hit the profitability numbers, to hit the cash flow numbers, to hit the distribution numbers that you want to take out of the business, and to hit the valuation numbers that you're wanting to achieve. Begin putting that plan together. Look, even though you might not want to sell the business over the next 5 years, 10 years, whatever the time frame is, that doesn't mean that work-life balance is important. The distributions that you're taking from the business are important. Building enterprise value into the business so you have exit optionality is important. Just because you don't want to sell the business, in the next year or two, doesn't mean that you shouldn't be thinking about this stuff. You gotta be intentional about and I'm sorry if I'm hammering here, but you need to be intentional about the way you're thinking about the business that is going to minimize your personal risk down the road. And so that's that's all I'm saying. Even if you don't want to sell the business, you still want to build a better business. You want to maximize the profitability of the business. You want to create a great working environment for your employees where they have career growth. There are things that you want to achieve within the business, even though you don't want to sell the business in the near term. And I mean, whether it's us or someone else can help you think that through.
Thank you, John. I think those are the last of the questions. So if there's any last minute questions, feel free to drop them in chat now and we can answer those. In the chat as well, I've dropped the link for that complimentary valuation. So feel free to click on that and book a call. Um, Outside of that, any closing remarks, John?
No, I thank everybody for being here. I know you're busy. I know you got a million things that you're doing. I totally respect what you guys have built. The world is a better place because there are entrepreneurs like you that are out doing it. And if there's anything we can do to help you through this journey, we'd love to talk to you.
Mhm.
Thanks again for your time.
Yes, thanks everybody. Have a
Have
great
a
day.
good day.